Hey, deal makers, well, welcome to the show where it's all about financial freedom with real estate. Let's do this. All right, what I'm going to do today in this episode is just kind of give you my outlook for 2026. What does the multifamily outlook look like? The economic outlook, interest rates, cap rates, rents, all that stuff. And we're going to look back in 2025 and kind of talk about what happened and what really happened versus my prediction a year ago in early 2025, and then what really happened, why did it happen, and then that now instructs us to kind of figure out what might happen in 2026. So let's get into it here. 2026 market outlook. Hey, welcome everyone to my 2026 multifamily outlook. My name is Michael Blanc, and what I want to do here is to go exactly. I want to kind of review what has transpired last year in 2025, and kind of what I see my crystal ball for 2026. And if we haven't met before, my name is Michael Blanc. I'm the host of the podcast, the Financial Freedom with Real Estate Investing podcast, where we cover really everything around financial freedom with real estate investing, either passively or actively as well. And I'm also the author of the book by the same name. It's available on Amazon, over 1,600 reviews on Amazon. It's really a good introduction to becoming an active investor in syndications, a general partner as well. Though as a passive, you can get a lot of information around what a syndication might look like. And on the investing side, our investing company is called Nighthawk Equity. We have about $300 million of real estate in that here. So that's a little bit about me here. Let's look back first before we look forward, just so we better understand where we've come from, so we can better understand where we're going. Now, I was looking at my predictions for 2025, and I didn't get it wrong. Okay, but the predictions have been delayed. It basically was 2025 was basically a predicted to be a more of a year of stability, and while compared to 2024, that was the case. We actually had some declines in both prices and rents as well. So 2025 headlines is that we had strong demand. That is true. And we had the highest absorption of new units that we've had in 25 years. That is also true. But the supply kept pace. There was so much supply that came on the market that it actually not only kept pace, but it actually outpaced it a little bit, I would say. And so therefore, rent growth actually slowed, well, certainly sharply by 2023 standards, where rents went up by 25%. And so compared to that, it certainly slowed sharply. But really, what happened is that it was about flat to down, depending on the markets that we're in. So a lot of those things happened in 2025 that we predicted. The thing that did not happen was the absorption. The forecast in early 2025, even in Q2, was the absorption would basically make it so that rents would stabilize and go up in Q4 of last year. That did not happen. It's about to happen, but we'll see exactly what our predictions are in that case. So rent growth did actually go down. Prices actually went down a little bit more in 2025, not nearly as much in 23, but certainly not what we were hoping for in 25. So let's kind of dig into this a little bit here. So let's talk about the supply side, right? We've had like record completions over the last 3 years. So you can see here in this chart here is last 3 years, we saw a historically large wave of new apartment deliveries with more than 500,000 units completed just last year. And most of these projects were financed years early with free COVID money when interest rates were low. And then they all came online at the same time. It was so lucrative to build, but it takes 3 years for the stuff to actually come out of the ground. And that created a temporary oversupply in some markets, which pushed vacancy rates higher, but it also slowed rent growth in 2025. And irritatingly, it affected Class B and Class C rents, which is wild. I'll talk about it in a second here. Now let's talk about the net absorption. So a bunch of stuff always comes online every single year, but there's demand, and you can see the net absorption. If it's positive, okay, that means that more units were absorbed than were built, which is normally a healthy sign. And so in 2025, the absorption really rebounded sharply from 2024 and really more than doubled and exceeded 2020 levels. So you can see this giant so that means that renter demand is high enough that more apartment units are being filled and vacated, even with new supply coming online. So that's healthy for demand. However, because so many new units had recently come online, the strong demand didn't feel as impactful. So because of that, vacancies are still relatively high. They're lower than they were. Competition for renters is pretty intense, and many owners have offered concessions. And this kind of explains why rent growth remained weak last year and into this year as well. And when I say offering concessions, that's really more on the Class A stuff, the new stuff that came out of the ground. And so this really affected Class A rents, but because of it, it also affected Class B rents as well. Let's look at the outlook real quick on the supply moving forward. So you can see this is the supply. We talked about the supply earlier. And so the gray area is really the kind of forecast for what's coming onto the market. You see this huge giant spike that we were in last year. And look at the major drop off, right? So it drops off like a cliff and it bounces around kind of at a more normalized level. And so, why is this happening? Redfin's senior economist, as an example, he said builders are pumping the brakes because elevated interest rates are making many projects prohibitively expensive. And I would add to that also things like tariffs, supply chain challenges, things of that nature. And so that could lead to an increase in rents. That is true if the supply drops. But now you can also see now why on the supply side, moving forward, it's not about to improve. There's very limited supply forecast for the next 2 years. And we know that because of the number of permits that are being pulled right now, because the problem of new construction hasn't really gone away, right? Interest rates are still high, right? We still have expensive construction costs, the threat of tariffs and things of that nature. Yet still, for many, it does not make sense, especially at the current Class A rent levels, right? If rent levels float back up to where they were, before this happened, now the numbers start to pencil a lot as well. So we do have demand, and we had a high demand for it, but we also had a humongous amount of supply that we haven't worked through yet. Now, all of this we continue having a housing shortage in the United States. And so in the medium term, it will drive demand for said affordable housing. Here's a report from the National Mortgage Professional from mid last year. And every single year, we're between 3 and 5. I've seen more numbers around 5 million homes that were short. Despite everything coming to the market, there's still a shortage. So supply is kind of keeping pace with the demand as well. And all of this is really creating an affordability crisis. So this graph shows the discrepancy between renting and buying, in this case, the same kind of house. So why would you want to buy a house when a median priced home is nearly $1,200 higher if you were to buy it than the average rental home, right? It's a 64% difference. It's a historical high. And it's pretty wild, right? So a lot of people are going, why should I buy? First of all, a lot of people don't have the down payment, but the actual home ownership is the same as renting a similar house, right? So why would I need to come out of pocket and now take care of it, pay the taxes, all that stuff, when I can simply rent? A lot of people are choosing to rent, which on the one side drives demand. Okay, but we also it's a reaction to an overall affordability problem that we have in the United States, and even to the point where Trump, he's trying to solve this, right? He recognizes that affordability in the United States is a big problem, and he's trying to figure out what to do. Now, here's this asinine idea. I'm a real estate investor. I'm a billionaire real estate investor. I'm going to ban other investors from buying homes. Like, oh my gosh, really? Trump, did he actually do that? And there was another article in the Wall Street Journal today talking about the same thing recently, and again with no details around that. It's a kind of a silly proposal, okay? But he's trying to do something about it, right? Even things like, I'm gonna order my representatives to buy $200 billion in mortgage bonds in an effort to lower housing costs. So it's a little bit of a false start, I would say, but at least he's trying. What he recognizes the issue of affordability in this country. All right, now so back to the whole thing about the supply coming on. This is a graph I'm showing here of kind of the concessions for new leases that have come up, and there's just a graph that's showing kind of this bar between where the rent levels are and where the concessions are, and the concessions are over the last 2 years are just really high. And what happened really is that these Class A came out of the ground, and there's a lot of them. So they were competing against each other. In order to compete against each other, Class A operators dropped their prices and offered concessions like first month free, first 6 months free, coffee for free for the first month, all that kind of stuff, in competing with each other because there's so much Class A supply in the market. But what happened, and I'll give you an example. This varies by MSA and even submarket, but I'll give you an example. We had one property a year and a half ago we had a Class A open next door, which normally is not a really big deal because Class A is $400 or $500 more for the same unit because it's brand new and they have a bunch of amenities in there. And so this thing opened up, and in an attempt to fill all of their units, drop the price down to our levels, and we're like a B minus. Okay, built like in the mid 90s, and so rent levels came to our level. And now all of a sudden, our lead flow stopped because I'm getting the same unit in a fancy new place next door. Why would I go live in some place that's been 30 years old? And so what did we do? What did any other Class B, Class C operator do? We started to slowly drop prices. So now we were getting, let's say it's $1,500 for a whatever 2-bedroom, and now next you know it, 3 months later we're getting only $1,200, $1,100 for that same bedroom, because a $1,500 is what the Class A was charging. And so this makes it this does not happen very often in history. Typically, Class A stays in Class A, and we normally say that it doesn't really affect Class B and Class C, but in this case, it did. And so this is really why it depressed a lot of the rents down. And again, this varies by submarket as well. And so what we're looking for now, moving forward into 2026, is first thing that happens before rents go up is that the concessions burn off, right? So that line that's really high about giving 6 months for free, 6 weeks for free, 4 weeks for free, 2 weeks for free. Now you're getting a gift card to Starbucks. Now there's no concessions, and now rents are starting to go up. And we're looking for that because it's kind of a leading indicator. So that's still what's going on right now, and that's really what we're looking for here in 2026. Now, the forecast in 2026 is the consensus seems to be stability with potential for mild growth. Okay, super boring, but it's actually a lot more interesting than it was in 2024 and certainly 25 when things continue going down. So if you look at the different kind of reports here, this one is from the NNA, National Apartment Association, that increased in the rents across the board increased only 1.1% year over year. This is on the national side. Certainly Atlanta, it was down, I can tell you that. And so the general consensus for 2026 is modest rent growth, about 2%. Again, this is national. It's going to vary by MSA a little bit now, with more normalized rent levels of 2.5% to 3% in subsequent years. And that's something that one can build on, because 2.5% to 3% rent growth is what we underwrote with, for years and years before that. And you can get stuff done, especially with a combination of a value add deal with 2.5%, 3% rent growth. We can work with that. What we can't work with is 4% negative rent growth. That is not good. And so that's kind of the outlook for the rents. And now what about interest rates, right? Interest rates. And if you look at the consensus, there's the Fed kind of the dot plot graph of which visualizes each Fed governor's expectation for the Fed funds kind of year over year. And there's a bit of a spread here, right? Because for the first time, what's going on in the Federal Reserve is there's not the consensus that we normally get. And so if you look at this dot plot, you have kind of a line above that people say, oh, it's going to stay here, and then there's ones that say it's going to be down here. And so if you plot this out, it's mildly down. Okay, so there's a bit of a spread, but it's clear that the consensus for interest rate is flat to slightly down. Now, this is markedly different from what happened 2.5 years ago, if you remember, before the interest rate hikes, when the prognosis was, oh, yes, interest rates are going up. Everybody underwrote with higher interest rates. What we did no one forecast, including lenders who made billions and trillions of dollars of loans, was that the Fed would increase rates 11 times in a row. No one predicted that. And I know that for a fact, because otherwise no one would have issued loans for this property, because everybody would have known if we had 11 straight interest rates hikes, everything would be in default, or a lot of it will be in default, especially for variable rate loans. So I know for a fact that even the most sophisticated underwriters and analysts in the world did not forecast that. My point is, 3 years ago, the prognosis was interest rates are going up, which of course is bearish, right? What I'm telling you now is the interest rates is basically flat to down. So we have two things. We have stability, which is very valuable, and then the prognosis actually is lightly down, which is more bullish as well. Now, so what we're putting together here is we have continued demand for affordable housing, right? We have now a dwindling supply of new housing, which is good. Interest rates are flat. That should drive an increase in rents. Okay, now the wild card is the following, is the economy, right? So while we can accurately predict the supply side, because we can measure the permits pulled, we know it takes 3 or 4 years to come out of the ground, the demand side is a bit of a wild card. And that's a little bit what we saw last year, is that demand side was a bit of a wild card because it's going to depend a lot on what happens with the economy this year. So what the economy does will affect demand, and that and with that, the extent and timing of net absorption, of absorbing that new supply, and specifically bleeding off the concessions and increasing rents again, like we talked about earlier. So here are the short-term key risks to watch. Number one is kind of the slowing growth and consumer pullback. So while economic growth remains largely positive, there are signs of cooling that are emerging. Slower job creation, moderating wage growth. All this could reduce consumer confidence and therefore spending. And so because consumer spending drives much of the U.S. economy, even a modest pullback could slow growth and weaken housing demand. So that's one thing to watch, is kind of the overall, the economy. The other one, though, is the employment rate, which kind of drives the first one. But it's also important to watch, especially the unemployment rate among young adults. Okay, so alarmingly last year, especially in the last 2 quarters, the unemployment rate climbed to 10% for young adults. I think it was like 15 to 25, something like that, or whatever the case. The young adults, and those are normally the ones that are starting new households, moving out, et cetera. Now, the overall unemployment rate for some of the older age groups is just above 4%, which isn't too bad. But for the younger generation, it's not good, because if the trend continues, those young adults are going to continue to stay with relatives rather than going out on their own, which is what they really want to do, because they're eventually going to get tired of the relatives. But if they can't find a job, which has been hard to do, and pay for rent, it's going to be difficult to afford, and so they're going to stay put. So that's something to watch as well, is not just the unemployment rate in general, but with young adults as well. The other one, of course, is policy-driven uncertainty. So there's things like trade. We have unresolved trade negotiations and continued use of tariffs, and that's going to create certain headwinds for growth and add inflationary pressure. It has not happened to yet, but again, it's not over yet. So it takes a little time. And so at the same time, the Fed they face a difficult trade-off. Should they ease monetary policy, reduce interest rates, or stay restrictive, right, to kind of fight this tariff inflation thing that they're unknown for? So that's something to watch as well. And then there's obviously external and geopolitical risks. So ongoing global conflict, war in Ukraine, tensions elsewhere, Greenland. All these things kind of pose risk to economic stability, and these events can easily disrupt global trade, increase costs all around, and overall dampen business and investor confidence, and that adds some amount of uncertainty for 2026. So all of these risks could affect demand side of the rental property. Supply side is pretty determined and predictable, but the demand side, therefore the absorption, is a little bit more unpredictable. And what could happen is that the rent growth and the absorption might be delayed still a little bit more. So wrapping up the outlook for 2026, I think it'll be a year of stability that sets us up for longer term growth. Year of stability, setting us up for growth. Now, the last 2 years can be described as, from catastrophic, tumultuous to decline, whatever you want to call it. But we had significant headwinds in the multifamily market, a significant decline in rents and valuations. And 2026 is likely going to offer some stability with regards to interest rates and rents. And that's going to create an environment for potential of mild growth, hopefully this year, by the end of the year. But that does set us up for stronger growth in 2027 once these units are absorbed, Class A concessions bleed off, and go back to normal Class A rents. So rents are going to start going up, and that will not in the short term affect Class B rents as much. But typically in these 2 bedrooms like I'm talking about, there's about $400 or $500 difference in Class A and Class B, right? So as Class A starts going up, Class B and C are going to follow in footsteps. So there's typically a gap between these different classes, and they move in lockstep. And it came down so quickly with Class A that it kind of collapsed on top of Class B and Class C. And so that should start to normalize as well. So this kind of, in my mind, makes 2026 a good time to invest in multifamily. If anyone is invested in multifamily over the last 3 years, it's a bit of a slog. You may have invested passively. Distributions have stopped. You may have lost equity or reduced equity. And it's been a tough time for operators fighting a significant, number one, market headwinds, okay, both from an interest rate perspective, but also from the rent perspective. And that's on top of any kind of operational headwinds that the operator may have. But the lesson is, just because you're a good operator and you're fighting the market and you're fighting interest rates, still you're not winning. I mean, I consider myself a relatively good operator, though there's a lot of things we can improve, but we have a property, at 94% occupied and sucking wind for the reasons I just mentioned. And so being a good operator, while is amazing, it makes it very difficult, almost impossible to win in this market. So the last 3 years have been disappointing for both the operator, but also anyone who has invested in deals as well. Now, the question is, what do you do moving forward?
All right. Well,
especially, and this is the challenge I think we find in people who have been in the business for a while.
This year in the
There
economy.
is a
whatever that you
reduction
do,
in
just make
appetite
sure
for
you
buying
take the
deals.
next best step.
And
that's
so
why I
a
put
lot of people
the
have
Freedom Podcast
exited the business
together,
or
so
pulled back in
whether
the
you're
business.
passive or active,
even to us
your
in some
GP or
degree,
LP,
pull back a little bit.
Take the next step,
because
whatever
we've
that
gotten
is for
cautious,
you.
right?
When you get burned
about it,
you become a lot more cautious.
Same thing happens on the passive
whatever
investing
that next
side.
step
You've
is,
been burned
go ahead
once
and
or
take
twice.
that next step.
You're like,
oh,
this is bad. And
have
I
you
think the
guys
challenge
learn
is
a little
that
bit.
the
I want
lesson
you to
is
do
not,
something
with this
multifamily
information.
is bad.
So, right?
Hopefully that's cool.
That's not the lesson. It's something like in 2008
All right,
when a
Eddie, I
lot of
appreciate
people
you
lost
guys.
a bunch
You
of
guys
houses
take
in
care.
2008, and they're like,
enjoyed it.
real
You guys
estate
have
is
a
bad.
great
I'll
rest of
never
the
do that
week
again.
and,
That's the
weekend.
wrong lesson, right? The lesson really is, no, real estate is not bad, right? Maybe a particular asset class went into a cycle downturn. Maybe something happened that created a temporary blip that caused losses, but it doesn't mean you should throw out the baby with the bathwater. What it does mean, though, is that you understand, that we collectively understand what happened and what is likely to happen moving forward. And I say that because that makes us the more sophisticated investor. And we see a lot of our larger investors and sophisticated investors who are now coming back, recognizing what has happened. They understand what's happened, the confluence of events. They're looking forward because they're always looking at, how do I get the best yield for my money? How do I get the best risk-adjusted return for my money? And they're always calculating. And to some degree, they're able to be a little more objective with their money because they understand this is a long-term gain. It's a portfolio approach. It's an asset allocation game. Sometimes you're going to have winners. Sometimes you're going to have losers. And the sophisticated investor understands that. The problem is, most of us, even if we think we're investing, we really invest with our gut and with feelings, right? And this is exactly what happened. Back 3 years ago, we all invested with our feeling. Which one was that? That was greed, right? Everyone's like, everyone's plowing into the business. Everyone's throwing money in. Valuations are frothy. No one's doing due diligence anymore. Everyone's jumping in the game, right? So there was this greed that was fueling that. And now it's a little bit the opposite. Right now, my prediction is that we're going to get a lot of opportunity at deals that are priced 35% below where they were 3 years ago. And there's a lot of fear in the market. And so a lot of people are like, no, I'm not going to do that anymore. I'm not going to become an operator. I'm not going to invest with an operator passively because I kind of got my butt kicked a little bit more. I'm not going to do it. Now, if you look at it objectively, okay, if someone comes in, if you're coming into this, you've never invested in multifamily before, okay, and you've never been an operator before, you flipped some houses, maybe you have some rentals, you've never passively invested in syndication, you have an advantage because you don't have that baggage from the last 3 years. If you look at it, you can now look at it objectively. You can look at all these numbers yourself, as you should, and you should research and look at the reports and see what they're saying about absorption, supply, demand, projections in rent increases or decreases, projections in cap rates, these things, and look at it objectively, and you will notice that our environment now is substantially better than 3 years ago. And so that even though we're not expecting a lot of growth, what we are expecting is stability. And I'll take stability any day because I can try to get into a deal this year. And I'm not going to win records for this year, but I will now be in a deal in 2027, right? When everybody is probably going to start getting into the business. And then probably by 2028, it might be a different world where it becomes hot again. And this gives us an opportunity to get into something what I consider the ground floor. This to me feels a lot like 2028. And there's a lot of fear in the market, and the really good and sophisticated investors were backing up the truck and buying as many houses and REOs that they could because they understood this. They saw the unnatural drop in the fundamentals, that it was an irrational act. And I feel like to some degree, it's a bit of an irrational act as well. That was well understood by declining interest rates, by free money, low interest rates that drove the bubble of building. And then number two, right on the tail end of that, a humongous increase in interest rates. And that confluence really combined like a freaking freight train last year. those two things really combined, and it's an unusual concentration in the history, and we have to understand what caused it and what is the likelihood of that happening again or something similar as well. So what I'm saying to you right now is the risk-adjusted return is much better than it was 3 years ago because the prognosis for interest rates is flat to down. That's good. The loan proceeds we're getting is much lower than we got 3 years ago. 3 years ago, we got like 85% loan to cost. I could finance everything. I could finance the purchase, the closing costs, the construction. Now we're getting 75% of the purchase price, okay? I'm not financing any kind of closing costs or certainly not construction. So the leverage is much lower, which is also less risky. And so the market is really poised to basically start rebuilding. Now, is this going to be a get-rich-quick scheme thing? No, it is a long-term wealth thing with a lot of tax benefits as well. So that's kind of what I'm thinking here is it's a year of stability that sets us up for growth probably in 2027, and we might get some moderate growth this year based on what happens with the economy. So in my mind, investing in multifamily syndications is still a powerful wealth builder. It should be a plan A if you want to actively invest in real estate yourself, because we have multiple people here on the call, people who want to become the operators and the GP, right? This is still a much better plan than buying a rental property or flipping a house or buying a short-term rental. Okay. And also, if you are a passive investor and you're looking to how should you allocate your asset allocation, right? If you're looking for there's been a lot of demand recently, rightly so, for real estate debt. A lot of people investing in real estate debt, returning a basic 10% return on that money, which is super cool. But again, you don't get the upside, which no one cares about right now. But you're also not getting the tax benefits. So if you're looking at your asset portfolio, you just take a look and you have real estate and debt in there. You should do that, and then also real estate equity, because you do get the upside if the upside is there. Obviously, if it's not, then there's no upside. But you also get the tax benefits of that, which you don't get on the real estate debt. Then there's obviously stocks and bonds. A lot of you are invested in that, and then there's private equity, which is exciting to me as well, because we eventually want to offer all three asset classes to our investors, because that's what I'm looking for. I want to be invested in these kind of asset classes where I have some real estate debt, I have some real estate equity, and then we have some private equity, right? So what we're going to do is we're going to buy an operating company, and that allows the common investor access to an operating company that normally is not possible unless you're in some kind of private equity fund, $100 million fund that is only accessible for very high net worth individuals that have really good financial advisors that can actually do diligence on these funds and then invest in those funds. So I'm really excited about that. So what I'm telling you is take another strong look at multifamily if you've kind of been in it or you kind of feel scared by it, because the opportunity really is there. And I think 2026 is the year to start getting back into it if you've gotten out it. And certainly if you have not done anything yet, it's a good time to start, because we're about to, in my opinion, enter a period of relative stability, which we have not had in 3 years, and then back to more normalized growth. So I just want to leave you with a couple of resources here. And the easiest place to send you guys is thefreedompodcast.com. I shout this out on the podcast, obviously, all the time, but it's a great place for both active investors and passive investors. So if you go there, you can just select, hey, I'm an active investor. I want to be an active investor. I want to be a GP. I want to find deals. I want to raise capital. I want to do that because I think it's the fastest path to financial freedom, which is. And if you click on that button, you can get our scaling course, which basically introduces you to the world of syndications. It's a shorter version of my book, but it also has me talking, so maybe more entertaining. I don't know. But you can also book a call with us if you want to explore joining our community or getting mentorship if you feel that's useful. If you want to invest passively with real estate and investing and real estate, then you have similar resources. We have about a 3-hour course on introducing you to real estate syndications, what a syndication is, how it works, how the deals are structured. So if you're new to syndication, that would be a good path. And if you're kind of looking for active deals right now, there's also a place to book a call with us and get to know each other. And we'll brief you on some upcoming opportunities that we might have, some multifamily deals, and then potentially an operating business that we're looking for right now.